Welcome to another episode of the Einstein Retirement Daily, where we curate financial, economic, and market news for the headlines that affect today's retiree. Coming up on today's show, we're going to talk about inheriting dollars and what you should expect if you inherit accounts starting this year and beyond. As always, this podcast should not be construed as specific tax, legal, or investment advice. If you hear something today that causes you to want to take some action, please confer with the appropriate tax, legal, or investment professional prior to making any changes in your situation. Okay, for those of you who are active and avid listeners, I do apologize that I've been out for a little over a week now. Got pretty sick with some kind of infection. I've gotten notes from some of you, and so thank you for that. Thanks for checking in and seeing how I am. I appreciate that. But yes, I was under the weather, a little bit ill, and maybe a lot ill is a better way to say it. I wasn't doing so hot. Not really sure what the problem is. It's one of those awesome deals where the doctors can see that I have an infection. They can see that my white blood cells are up. They can see that my inflation markers are up, but beyond that, they don't know what's wrong. So I'm working on some antibiotics and I'm feeling a lot better, probably around 85-90% at this point, so feel pretty good. So wanted to kickstart and get back into doing the daily podcast. I did not want to go without doing one for any longer. And so I figured it would be a good time to launch off today's topic, focused on something that is a common question, something that we're hearing feedback from a lot of folks about, and that is what happens when I inherit dollars, say from a parent who's passing away. Obviously, for those who are getting close to retirement, you're generally in your 60s. Your parents might be in their 80s or maybe even as old as 90s, sometimes even older, depending on your upbringing and situation and when you were born and all that good stuff. But retirees often are inheriting dollars around the same time that they're retiring. And so it creates questions. What happens from a tax perspective? Will I owe taxes? How is this going to go? And then more specifically also, how are these RMD rules going to affect me? Because I think I heard there were some changes. Yes, in fact, there were some changes. So we're going to cover that today. No articles to link in today's episode. Just going to talk about something I know a lot about and is a common question that we're hearing from folks. So, inheriting dollars. Generally speaking, dollars that you inherit from a parent or a relative, when you inherit those dollars, taxes have already been paid, generally. Meaning, let's say they owned some stock, and that stock was then sold, and then you receive cash. If you're receiving cash, so just dollars, not assets, but dollars. Generally speaking, the dollars that you inherit have already had any tax exposure taken care of. You're receiving it after that tax has already been paid, either by the estate or by the last and final individual tax filing for your deceased loved one or friend. And so those dollars generally are not going to be taxed. Now, an exception to this would be if you're receiving assets. Now, what it counts as an asset? Well, if shares of stock would count, property, real property like a home or vehicles, those sorts of things. Now, currently, the way it works right now, if you inherit those types of dollars, you get what's called a step up in cost basis, which means that when you inherit those dollars, you will see the value and what your cost basis is. They should be identical or roughly close, okay? An example of this would be, let's say I inherit some stock and my parent owned that stock and they had purchased it for $5 a share way back when. It's now worth $20 a share. They pass away. When I receive that stock, whenever they passed away, whatever the value was at their time of death, say $20, that's now my cost basis. What that means is that if I go and sell that stock, my cost basis will be $20. So if I sell it for, say, $25, I actually do have a gain there, $5 a share. But if I sell it for $20, I just get the cash. There's no capital gains tax to worry about, none of that stuff, okay? So that's what happens with assets. You get a step up in cost basis so long as you sell them for what your new cost basis would be, which is the value, estimated value at the time of death of your loved one, then there wouldn't be any taxes due. Any sale that's more than that is a capital gain. Any sale that's less than that is a capital loss. Now, where it starts to get a little tricky is when you're inheriting dollars that are IRA or Roth IRA or 401k or 403b or any of these other types of accounts. Any tax qualified accounts, so that's going to be your 401ks, 403bs, 457s, TIAAs, TSPs, IRAs, simple IRAs, SEP IRAs, all of these types of accounts. When you inherit those dollars, you take them one of two ways. Either you take them as a lump sum in cash and the entire balance, whatever you receive, is immediately taxable as ordinary income. Goes right to your tax bracket, whatever tax situation you're in, that's the taxes that you'll pay. Okay, so that is those tax qualified accounts. The second way for you to inherit those dollars is to inherit them as an inherited IRA, meaning you open a brokerage account at a custodian like a Schwab, TD Ameritrade, Fidelity, Vanguard, any major brokerage institution will be able to help you open an inherited IRA. When you open that inherited IRA, you can take those qualified, tax qualified dollars, put them into the inherited IRA, and there is no tax consequence for doing that. So you get complete tax deferral by putting it into the inherited IRA. Now, the way it used to work on the old tax code before the most recent legislation that came down around the same time as COVID, the way that it worked was you were allowed to take it out over a structured payment period as long as over the rest of your lifetime. So you could have lifetime payments called required minimum distributions, and those payments could just continue to pay to you so long as you're still living. That was one option. Another option was to take it out, say, over 10 years or to take it out over 5 years. But any amount that you take out in a particular year, you're going to pay taxes on. The way it works now is a little bit different. Now there's just a mandatory, set in stone 10-year rule. But that rule does not work like the old rule where if you selected a 10-year payout, you're going to receive a check every year for 10 years. That is not how it works. The way it works now is that you will have full flexibility for those 10 years, but every dime in that account must be distributed by the end of the 10th year. So, if you have $100,000 in that account, you could take $50,000 out right away, wait 9 years, have the accounts grow maybe and earn some interest. Maybe you have $60,000 that you pull out 10 years from now. Or you don't touch it at all and it grows and grows and grows, and maybe you have $120,000 in 10 years from now. Or you invest really well and it's worth $200,000. Okay, the point is you have full flexibility to not touch it for those 10 years, and you can pull it out all in one shot in the 10th year. Should you do that? Well, it depends on your individual tax situation. So you need to be mindful of several things. One, the current tax code is good through the year 2025. In 2026, we revert to the old tax code. And what that will mean is that likely taxes that you would owe on these accounts are going to be higher in the future than they are today. So there is some incentive to distribute these accounts maybe more in an even way, or maybe out in as few as 5 years, unless of course you have some events coming up like retirement where you could see your earned income go down, creating tax flexibility. So maybe you don't touch it at all for the next 5-6 years and then pull out larger sums once you're retired. So there's lots of tax flexibility that you would have with the new rule, But the one flexibility that no longer exists is you cannot wait your whole lifetime to disperse it. You must pull out every dime by the end of the 10th year. This is also true for Roth IRA accounts. The difference with Roth IRA accounts is that Roth IRA accounts, there's no tax hit, right? So whether you pull it out tomorrow or you pull it out 10 years from now, the taxes are the same. So generally speaking, the advice, so long as you don't need the money, would be to let those dollars continue to accumulate tax-free in that inherited Roth IRA account through the end of that 10th year. Now, if you are the spouse of the person that you're inheriting these tax-qualified accounts from, you just want to maintain what you previously could do and can still do, and that is a spousal inheritance. If you take it as a spousal inheritance, then it enjoys full tax deferral. You take it as if it's your own account, and you get to just treat it like it's part of your regular investments, and it keeps it very simple from that perspective. Okay, I'm glad to be back. Glad to share this information with you. As always, subscribe, share this video if you found it to be helpful, follow our Facebook page, subscribe to the YouTube channel, give this video a like, and we'll talk to you next time.